Howdy there, folks. Welcome into the Reaction channel. It's a buy one, get one free here tonight. 2 videos for you to react to. The first one I'm looking forward to here is bears might have it completely wrong on recession outlook. So this should be an interesting one. Obviously, we know recession's been highly predicted for the past about a year and a half now at this point in time. And everybody's looking and they're like still 3% something unemployment. Like, what's going on here, right? So the longer this thing goes and the longer you have this very low unemployment, the more people are going to question, recession more and more. So this is interesting. I'm looking forward to getting into that one here in this video. And then second video is, if you didn't already know, big dog Apple's reporting earnings this week. Okay, this is obviously massive for the market. It's obviously massive for any Apple shareholders, or if you own semiconductor stocks in general. And I certainly own a few of those. Skyworks Solutions, Qualcomm come to mind. Hedging into Apple earnings might be your best move. And I want to hear what the chart master Carter Worth has to say in regards to how's he planning on hedging, or how should folks hedge. I think it's a big subject. So appreciate everybody joining me as always. Thanks for being subscribed. We're now at 26,200 plus subscribers. I appreciate y'all. Also, everybody that's going to see this video within the first few hours of it being out, do keep in mind the $10 Patreon tier is going bye-bye for anybody that basically join within the next few hours, and you'll be grandfathered in. If you don't join the next few hours, that tier is going bye-bye, and then we'll only have the $19 tier after that. So I'll be pinned comment down there. Once again, everybody that's already part of that, you're already going to be grandfathered in, so you'll stay at that. But then for any future folks, you'll only be able to access that $19 tier, just so you know. Alrighty, guys, let's get into this.
Wednesday's Fed decision as stocks head for a mostly positive monthly close. How will the critical rate decision impact the market and recession odds? Let's bring in Ed Clissold, Chief U.S. Strategist at Ned Davis Research, and Jeff DeGraff, Renaissance Macro Research Chairman. Good to see you both. Jeff, just in terms of the market setup here and as it relates to expectations for where we are in this economic cycle, a lot of credit being given to the market for kind of hanging in there, and a lot of criticism of the market for how it's doing it, which is with only a handful of stocks. What's your read on that?
Yeah, I think breadth is being overplayed. That can catch up very, very quickly. Breadth was pretty good up until Silicon Valley Bank, and then it did fall apart. It hasn't made a new low, but I think that's a technicality. It's pretty close.
I know for the super advanced investors, you know what that man's just talking about theirs. But for the folks that maybe don't know what he's talking about when he's talking about breadth of the market, he's basically talking about there's been an interesting divergence that's happened recently where the biggest of the big dog tech companies have kind of exploded to the upside, but the rest of the market hasn't really been doing much of anything, to be quite frank. And so it's creating this interesting dynamic where the rich are getting richer, as they say, right? Where the very largest companies, the Apples and Microsofts, Metas, like those sorts of companies, have kind of exploded to the upside here. But meanwhile, you have 90+% of stocks underneath that haven't really been doing anything. And people are like, what's going on here? Like why are only these stocks going up and not all these other ones? And so it's pushing the indexes up. The indexes are great because remember, almost all the indexes, almost all of them, are weighted in terms of the biggest market caps, except the Dow. The Dow is a different weighting. That's not a good way to weight it because they weight it based upon share price. But almost all the other indexes are weighted based upon market cap. And so if you just have the few of the biggest big dog companies, it can make the whole index go up. And so that's an interesting thing we have going on in the market right now. And that's what he's referring to, that it's kind of overplayed and that can easily play catch up, which, it certainly can happen in a matter of a few weeks or a few months.
Doing so, most of the weakness that we see in small cap, I think you can look at from a sector differential, right? There's about twice the weighting in small cap names as there are in large cap names for banks. So, I just got back from London last night, actually, and it was certainly a topic and an area of concern with clients. But I think the other thing to just keep in mind is how much better the global indices look than the U.S. indice. And if you gave me a choice between stronger global indices and weaker breadth domestically, or vice versa, I'd take the former. I think the breadth that we're seeing globally is more important about the economic outlook, about really the health of the market, than what we're seeing from, I think what can be characterized as probably some concerns around the banking system, but other than that, pretty contained.
That's a good point. And Ed, I know you've been doing a lot of work on what is an admittedly ambiguous picture of where we are in terms of this market being a new bull market, being still kind of stuck in the bear phase, and really conflicting evidence working in both directions. Where do you come down?
Yeah, so we're most likely in a bull market, even though we haven't made, a technical definition of one. And I think we really need to think about it is that in the early phases of a recovery, say around year 2 or 3, it's not uncommon for there to be fears of a double dip because the U.S. economy is so large, so developed. You're not going to maintain the growth rates that you get coming out of the recession. And so those fears of a double dip cause the market to pull back. But
that is a good point. That is a great point, actually. I am going to push back against that in just a moment here, and I'll explain why I'm going to push back against that. But yeah, coming out of the great financial crisis, there was all this, it was around 2010, 2011, all this double dip recession fear of, we are going to go back into a recession. And anybody that was in the market that was participating, like I was participating back then, about that. And the market went through some pretty big volatility. I think it was kind of toward the end of 2010-ish, if I remember. And I remember still them talking about that even into 2011. Double dip recession. If I had, my gosh, $1 for every time I heard that term on CNBC during that time period, it was ridiculous. I had them so sick of talking about double dip recession all the time. And they kept talking about it, and it never happened. And we just kind of kept prospering. And then growth actually picked up nicely kind of toward, 2012 into 2013, 14, and growth kind of picked up from there, right? And so anyways, it is kind of like a thought process that's important. Now, the one thing I'll push back against is obviously at that time we had rates at near 0%. Right now we have rates around 5% Fed funds rate, right? So it is something that's working against the market right now. But on the flip side, you can say, well, at that time we had real wages that were starting to improve. Recently we've had 24 months, but what happens if real wages actually start to improve for the first time in 2 years? What happens if that plays out? What if consumer confidence gets better? Last year, we hit the lowest consumer confidence in the history of the Michigan Consumer Confidence Index that goes back decades and decades and decades, worse than the 1970s, worse than the Great Financial Crisis, worse than Rona. I mean, it's incredible when you think about it from that. So what happens if consumers just feel a little better? What if real wages start going up? What's that going to mean for the economy, right? And does that put the chance of recession at even a tougher standpoint? Never mind if we can get inflation more under control, hit in the 3s, then bring Fed funds rate down to 4s or the 3s. Oh boy.
Because double dips are very rare, only one in the last 60 years, that was in 80-82, that bear market tends to be cut short. And that's pretty much what happened in 2022. We had a growth scare, we got a bear market, but it really fit that kind of non-recession bear scenario. And so what we could see from here, is a recovery that could last at least until later on in the year, and then we'll have to see if the recession risks really come to fruition and actually we get the recession going into next year.
And Ed, I know you're also focused on some of the maybe oddities or distinguishing characteristics of this cycle when it comes to the interplay between the markets, the economy, Fed, and things like that. And basically, if we don't get a recession in the next month or two, it would perhaps be the longest time between an S&P 500 peak and the onset of a recession that we've ever experienced. Is that right?
Yeah, so on average, the market peaks about 6 months before the start of a recession. There's been some variation around that, but the longest we've gone is about 17 months. And so if we peaked in January of 2022, once we get to mid-year, we would have blown past that record. And so what happened last year is the market went down in anticipation of a recession that just hasn't happened yet. And so we have this window because of the resilient economy for the market to rally. Maybe we just got a little ahead of ourselves in anticipating the recession that was supposed to start last year that just hasn't happened.
And Jeff, I guess whether or not we should be broadly concerned.
I'm not even going to go there, but we could debate that we actually had a recession in 2022 based upon almost every single metric you could possibly imagine other than unemployment rate.
About the fact that it has been some poor breadth in this market, I guess it should instruct us how to play it. I mean, do you look for laggards or is it about essentially, being selective about what's already outperforming?
Yeah, I mean, we haven't seen the extreme yet to get us to sort of flip. So we're still momentum players in that realm. But I do think things like semiconductors, as an example, we're seeing some corrections there, which are still in very good uptrends from our work. We're starting to see some emergence out of healthcare equipment names. Absolutely, at this part of the cycle, that's something that can work as they tend to have a little bit more cyclicality within healthcare. So, we tend to stick with the winners, particularly in an early cycle. I would agree with Ed. We're in a bull market. It is not a table-pounding bull market. I actually think one of the ironies might be here that the bears will get emboldened by a recession. And even though we don't really see that happening here, let's say that that we're wrong and we see that that comes to fruition sometime, maybe late in the summer. What's interesting is one of the things keeping a lid, in our view anyway, on the S&P is the relative attractiveness of what you're seeing in the bond market. And so a recession actually would end up pushing yields down, which therefore could actually give a bid to equities as that yield differential starts to make equities look a little bit more attractive. So bonds bears might actually have it completely wrong, that the recession ends up being bullish for them versus bearish. So we'll see.
Yeah, that could be an interesting dynamic. One last thing I want to cover that's worth addressing there, right, is when fund managers are bullish and, let's say they're saying, I think they're wrong about recession or this or that, right? Some people run to the conclusion of, oh, yeah, sure, they're saying that because they just want to keep their clients invested so they can, earn the fees on that and whatnot, right? I can tell you this. You can make actually far more money if you were actually coming from more of a bearish standpoint from your clients, at least in the short term, because the more you kind of preach that, the more your clients kind of need you to navigate that sort of market. If you're just kind of bullish and you say, stocks are going up, then us clients could just move money to an index fund because they're like, oh, we're in the clear, we're fine. When things get shaky, that's when people get uncertain and they're like, wait, how should I navigate this, right? And so I just think that's always an important factor to keep in mind, that a lot of fund managers sometimes it might be a little more inclined to preach doomsday type stuff because they know then their clients are going to feel like they need them because they're going to have to do more advanced strategies. It's not just buy the Qs and we're good. It's not just put the money in the S&P 500 index and we're good, right? By coming out and saying the S&P is going to fall 20%, 40%, 50%, whatever, clients start thinking, well, I would love to capitalize on that, but I don't really know how to navigate that. And so they're much more inclined to give their fund managers money. And so that's just, I think that's something that, has to be thought about both sides of it, okay? Next one up here, hedging into Apple earnings, okay, maybe a little something more advanced here, might be your best move. Let's hear what they have to say.
The FANG earnings reports next week, but how will the stock hold up compared to its big tech peers? Let's ask the chart master, Carter Braxton Worth of Worth Charting. What do you see, Carter?
We shall see. Of course, my bias is that it's priced in a whole bunch. We have a well-defined series of lower highs since its peak. And we know, of course, it peaked the same day the market did. It set the high for January 2021. And the issue is interesting. The implied move in earnings would take you right back to the August high from last summer. So we close around 168.70. That high is 176. 3.9% would get you to that high. Either way, I think you would be right to hedge going into earnings. And in the event that it pulls a pop, like a Microsoft or something like that, I would sell into the pop.
How do you see the pop that a Microsoft had, for instance? Is that a sustainable pop? Does it mean anything good in the future for Microsoft, or is this just a pop?
Right. Well, so the magnitude of a gap up or down often determines how much is priced in. And for instance, when a bank drops and gaps 30%, it finds a floor. Or when you gap up like a Meta, notice Meta doesn't move now. If the pop is small, 3, 4, 5%, you can get follow through or the drop.
What? Meta doesn't move? Meta doesn't move? What? Did he miss the move that happened this week when Meta was up like 14% in a day? Well, what are we talking about here? I don't know. What? I don't know if he misspoke or he hasn't been keeping track of Meta stock. I don't know what that man's talking about. What in the world?
But when it's epic, 10, 12, 15%, markets are pretty efficient in repricing a security to where it belongs. So in the case of Microsoft, I would start to reduce exposure, certainly Meta.
So how do you look at, for me...
Mr. Carter Worth, have you missed that, sir? Have you missed all this? What are we talking about here, sir?
The big shiny number of Apple is that 182.86, the $3 trillion market cap number.
Well, that's the former high.
Yep. Right? So when you look at that, it's either a magnet or it's kryptonite for these stocks. And usually it's kryptonite first, and then it becomes a magnet. I feel as if they're chasing that number, and everyone's put it into their algorithms as their sell stops, basically. But then it breaks through it. Markets have a way of breaking through. What do you feel about that number?
Sure. So I said the first key level is that August high, the high that set the market high for the S&P and for Apple. Were we to get through that, right, then you are looking at the former high. When you first approach a former 52-week high or low, before you go through it, you contend with it. Just as a matter of technique, right? So when a stock goes quickly to a 52-week low, it typically doesn't crash through. It backs and fills and then goes lower. So to your point, it is a magnet. I don't think we're going to get there in this earnings print, but if and as we were to get ultimately to the high, you almost never break out initially. You contend, which is to say you back away or you back and fill.
Carter, we will see you shortly on options action. Thank you, Carter Braxton Worth of Worth Charting. Guy, how are you feeling
Before we get into more of this, okay, so hedging strategies on an earnings, okay? So what you could do if you really felt like you needed a hedge for a stock, let's say you're super heavy long a stock, let's say you got $100,000 in Apple, let's say, for instance, and you're like, man, I'm really worried about these earnings. You're like, I think it's going to go down, but I don't really want to sell the stock. So what you could do is you could buy, let's say, some 160 put options, something that's at a 160 strike price, maybe a 155 strike price, maybe a 157.50 strike price, something like that. So just in case, for whatever reason, the earnings are really bad and the stock tanks, you can obviously save some face in a situation like that. Other than that, I mean, you could sell, but it's just like, if you're a long-term investor, it usually doesn't make sense to try to time these things out like that, right? If you want to buy $1,000, let's say you had a $100,000 position in Apple and you want to buy $1,000, $2,000, $3,000 of puts on the stock, you could do that. You don't have to do it just for 1 week out. You could always go a month out. You could go a couple months out, something like that. If you're just really concerned about Apple stock price in the short term or something like that. Now, those decisions or a little more short-term in nature decision. So, you don't want to get too far into that mindset, because the next thing you know, you're making short-term decision after short-term decision. You can always hedge your portfolio going into a new year. You can always hedge your portfolio going into a new year just around November, December, or if you're a little late to the game, you could do early January hedge and be good, for the year in terms of that.
Apple.
Well, lower, it's clearly, as Tim pointed out earlier, I mean, big cap, high valuation tech, which Apple is, by the way, is a flight to quality. It's what we're seeing over the last couple of weeks. And I understand it. When banks are a scary place to be, people want to go into these great balance sheets. It makes sense. But it comes down again at some point to valuation and slowing growth. And that's been the story about Apple over the last few quarters, regardless of what people want.
Crazy to see it at that forward PE. And also do keep in mind, I bet you any money, ton of analysts are going to bring up their EPS expectations. Bet money on that. And after it's made that huge move, it's still the most undervalued of big tech. That's why Meta just has still crazy upside over this next few years.
Believe if you just look at the numbers, things have been slowing down and the valuation continues to get higher. So lower highs, lower lows, makes sense to me. You're taking profits here.
Tim.
Yeah,
They got the Titanic on in there, man. It's my favorite scene. It's like when the ship's like completely like this. I don't, did that even happen in the Titanic? Like seriously, like I don't even think that. Could that even happen? A ship go straight up like that?
The setup into Apple is different than the setup into the other stocks. I mean, every other mega cap tech stock, depending on even what they did afterwards, they all reacted somewhat differently. But the numbers were such that it was a relief week. It really was. Interesting, by the way, Apple's reports so much later than the rest of mega cap tech. I'm not even sure why that is. We usually get them all in the same.
I agree with that, and it is a bit of. I'll speak about the relief in a second.
Okay, so Apple's now sitting out there mid next week. If you look, and this is putting my Carter hat on a relative basis to the S&P, we're back up to this level that it's been at a couple times over the last year on a ratio chart where I think you run into resistance. And again, outperformance of the S&P of almost 23% in the last 4 months is heroic, and it makes sense. We know why, and a lot of that came after SVB. So no, I think like others, it sounds like Apple's probably going to need to really knock your socks off, and that may not be enough.
Yeah, most important thing to me is Apple's obviously the largest component in the S&P and in the NASDAQ. Both of them are below their February 2nd highs. And given everything that's happened this week, that to me is a little bit shocking. I don't think Apple's going to break out the indices.
Yeah, so in this sort of market, every earnings period that is not a disaster is a relief in a relief rally type situation, and that's exactly what we're seeing in this earnings season, where it's like, oh, we got through it, companies weren't devastated, and we've made it out to the other side. And I feel like it's probably going to be that same way next earnings season as well, until you finally get a confirmed either bearish scenario, recession, or you get a finally, like, everybody's like, we're in the clear now at this point in time. But until that, it just feels like every earnings is like, oh, we made it through. It's a relief. So appreciate everybody joining me as always. Thank you, everybody. Subscribe to the channel. Make sure you get us in that Patreon. The $10 tier is going away in a few hours. So if you see this in time, you'll be able to join down there, pin comment. If you don't see this in time, then it will already be bye-bye, and there'll only be the $19 tier left at that point in time. Much love, and have a great day.